GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, Jim, good to be with you. Here we are, and it's Friday, and it's time to review the markets.
So you're saying the Trump effect is still in effect?
Yeah, that's a good play on words. But, you know, in writing yesterday's piece, I got to thinking that a number of things like copper, base metals, to somewhat a degree, crude oil, and a number of the older type stocks, Caterpillar, the coal stocks have been going up all year. They really got excited and zoomed up, like starting a couple of days before the election. So it was reading the change, and then it's continued. But the other day they reported quite a good GDP number in the U.S. for the third quarter, which ends at the end of September. And then you've had, as I said, the rise in base metal prices had been modest, and then whoom, as it got into the Trump thing. So I'm thinking that through the summer there was building a positive, or a sense of positive thing, you know, a positive surge, I guess that's the word. And part of it was the Trump election. The people that supported him got very positive and went out and did things. And so it's a wave of plus went through the whole system. And I don't know how long the positive GDP will last, but some of these other ones that zoomed up, you had sharp rallies, particularly some of the cannabis stocks, which showed up in our chart, and we came out with a quick one on that one the day before the play took a hit. I think the stock fell 55% after that. So when you look at things like that and you think, oh my gosh, it's sort of a silly season, and you can get these in the markets and often it's sort of in April, May, where all of a sudden the most wildest things happen in the stock market. I remember back to 1996 when it turned out to be a promotion was fraud. Actually, it was Bre-X, that mining play, and it was going straight up, and then all of a sudden a bunch of small mining stocks just took off and quadrupled in a few days, and that actually marked, I think it was May 96, marks the top of that play. So we have to be aware of these silly seasons, and it shows that there is a terrific will to speculate out there, and how fully has it been expressed. So we'll see. The pro-business administration, I think, will be wonderful for the U.S. On the other, and also it marks an end to a long period of experiment and authoritarian government, and that is also marvelous. And so there will be improvements, dropping the tax rate from around 35% for corporations down to 15%. Getting rid of rules and regulations will be very good. Actually, with what you look at over the last 50 or 60 years, virtually every intrusion by government has not been good. why intrude? The marketplace can look after itself without any pushing or shoving by government, or governments picking winners and all that stuff, which is usually a disaster. So there was a philosopher back in the 1800s, Spencer, I think his name was called, and it was the simplest philosophy you could come out with, which was, government, don't rain on our parade. And it's quite valid. So here we are, a good speculative thrust going on. You've had in the credit markets a terrific steepening of the yield curve, which we've been on to since earlier in the year, and we also noted that when you have curve steepening, it's very helpful for the bank stocks. Their spreads are set up to make money on a steepening curve. This perhaps is about to run its course. Then also on some of the U.S. and Canadian bank stocks and the bank index in the States, BKX, it's given, well, the play has been so strong, it's given upside exhaustions and sequential sells. So it's the best is in, and any change in the yield curve, and there's been no steepening now for 2 weeks. It might take another run at it. And then, of course, over in credit spreads, which is the difference between high-grade and low-grade bonds, it's had an absolutely fabulous run since the disaster in crude oil ended in January last year. Spreads have narrowed hugely. And again, that action in spreads did reach technical excesses 3 or 4 weeks ago. And it's, let's put it this way, we can say it's narrowing has sort of stopped, although this week with the games that are going on in crude oil, where I read that Putin in Russia was instrumental in talking with Russian producers and Saudi and other people within OPEC, have come out with a promise all around that they're going to trim back production. This is a mug's game, because if you reduce your production to get the price higher, you're not selling as much of it as before. And these countries, Russia's short of money because the drop in crude oil from above 100 level down to even the current level at around 50, it's pretty painful. And Saudis, of course, borrowed a huge amount of money, and they have a problem. And the story that journalists in the oil patch are writing up, that Saudis were trying to break the market so that it would set back the fracking of tight structures in the U.S. That's nonsense. Well, you remember we talked about at the time that it was straightforward. We're in a post-bubble contraction when commodities don't do so well. You had the lead from natural gas heading down to a new price regime. It was just straightforward in 2014 to say that crude oil was going to go into the new price regime at something very much lower, which it has. And then there was this report I saw last week where general production from, say, the Bakken field of tight oil, the costs of extracting oil have fallen in half. That's just in 2 years. Then within the Bakken, there in North Dakota, there is a field that's about 2,000 miles square, so it's a pretty lot of territory. And their costs of production there are now down to, I think it was $15 a barrel. And that cost was falling. And then they announced in Texas another huge field that's bigger than anything so far. What was it called? Wood something or other. Anyway, so there's huge amounts of energy, either in oil or in natural gas. And so these guys in OPEC, as led by Putin, they're dreamers. They're fools to try and take this on. So anyways, but nonetheless, it's given a good little push-up for oil prices and oil stocks, and but I'm not certain how long it will last. So perhaps we can still look to a seasonal low somewhere in January, and then looking out into next year for crude oil prices, energy prices generally, you have two considerations. One is that the U.S. dollar is in an uptrend, which doesn't help commodity prices. And two, you've got huge amounts of capacity and production costs in the U.S. declining. So I don't see any huge rallies in crude oil. They might be able to get a spike up like recently on this supposed agreement, which I don't think will last too long. Or you can have some sort of another troubles brew up in the Middle East. But generally, I don't see anything that would prompt a major bull market in energy prices. It's just rallies, oversold to overbought on a modest basis is the best you can see there. The other one that we got going on here is since the blow-off in July on the long treasury market, long bonds, it's come down hugely. It's been quite a drop in price, about 20 points. And a week or so ago, we sort of got kind of oversold conditions here. So we think that the decline in bond prices on treasuries, the Government of Canada's, could pause for some weeks, maybe early into the year. But nonetheless, it is, we've got a bear market in treasury prices, which means treasury yields are going up. And this is, and also with the move, like in last summer, the bond bulls were fully expecting long treasuries, which are, the 10-year was trading at less than 2% then, were going to head to European yields on their 10-year notes. Germany's was effectively zero, so these guys were looking for a huge decline in yield, and we argued then that it was all in the markets, and that the U.S. market was less rigged than the European market, and if the U.S. market rolled over, it would take the Europeans with it. So anyways, as of this week, you've got German yields, UK yields, Portugal and Italy rising to new highs in yield for the move. So rates and with the bubble, with so many people leveraged in playing the interest rate games, this is beginning to get a little uncomfortable for them. So we don't see too much excitement in bonds. And you have until recently there was pretty hot action in junk and stuff like that, but we got technical excesses there. So the bond side is deflating the hugest bubble in history, and you've got a brief spurt of positiveness with the Trump election that could have been part of a whole wave of positive come through that reached some excesses. So we're looking at caution going into the new year.
We'll have more with Bob Hoye right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob, gold continues to go down. Has it been a disappointment, or is this a case of maybe you should wait for prices to go even lower before getting in?
Yeah, we do some pretty intense work on the precious metal sector. But we also do the same intense work on the U.S. dollar. So U.S. dollar is in an uptrend. And so you can't get excited about gold in U.S. dollars. But say if you're in an area, Europe, where you have a weak currency, then gold is going to get marked up in those terms. But this is quite dismaying to the gold bugs who play everything in the U.S. dollar, and it just ain't going to happen. And if we go back to last July when the precious metal sector got way overbought, we noted that and called for a significant correction. And this is what we have. So now what we're looking at is the same thing we used in November, December last year, is you want to start to see the gold shares beginning to outperform the bullion price. And that reached a peak with gold shares outperforming bullion with enthusiasm last July. And now for the last few weeks, the gold stocks divided by crude are no longer going down. It's sort of flatlining, and what you want to see is this flatlining for a while, beginning to improve, and then breaking out, and then with that one can consider accumulating some gold stocks. So on this senior currency, which is the U.S. dollar, becoming strong, it's a feature of every post-bubble contraction whereby the senior currency becomes chronically firm relative to most other commodities, most other currencies and most commodities for most of the time. And this is what's been happening. So you take a look at the chart for the grains, sideways here since last summer. Base metals did have their rally, and they're giving up a little bit here, but actually the chart looks like it might be in a positive trading range into the new year. But you just can't see any major bull markets for huge moves for these commodity prices that are priced in U.S. dollars. And we'll emphasize again that the feature is a firming senior currency. And one of the reasons to explain this is that in the financial mania, most of the debt is contracted, written in the financial center, which is New York. So, and also due and payable in U.S. dollars. So all of the debt bubble is effectively a short position in U.S. dollars. So it's not urgent yet, but at some point, a lot of those people that took on the supposed free money are finding out that they're going to have to pay it back from their own weak currency into the strong U.S. dollar, and that can be very painful. As a matter of fact, this goes back to the great trader and financier in the 1500s, Thomas Gresham. And at that time, Antwerp was the money market, and his letters to the British Crown sort of explained the reality. Hey, you're borrowing money, and the sterling is weak, and you're going to have to pay it into guilders, which are strong. You don't want that. So this is the reality, and I find it really quite exciting to watch this all evolve. Even speaking of gold, within the new forthcoming administration, there has been discussions of perhaps returning the U.S. dollar back to a gold standard, which would be wonderful. And if, as we are in a great reformation, I think it's probable. He's had the head guy at one of the top think tanks, can't think of it at the moment, recently retired there in 2015. And he's been in discussions with Trump about a gold standard. Oh yeah, the Cato Institute, where that's a real top quality think tank group. So we live in extremely interesting times.
And Bob, before we go, we have a question. What does Mr. Hoye think that failing British land prices from 1873 up to, say, 1893 was the result of the financial crash of 1873? I see a different reason why that happened. After, say, 1860, 1870, U.S. agricultural production started to dramatically increase, and the U.S. even started to export grains to Europe. It led to falling food prices in Europe, and as a result, that development, land prices in England also started to fall. So if we have any agricultural production that kind of ties into what happened in the past, how does it tie in today?
Yeah, good question. I think I'm the one that came up with the chart on land prices. It was actually farmland values in England from 1873 to 1895, and they fell, on index, let's say 58 to 38, a pretty consistent decline. But on previous great contractions following a bubble, 1772 or even 1825, I didn't come up with any such price history of farmland values. So that was just the only one, and the conclusions on it were that when you're in a post-bubble contraction, farmland values go down, and you can also probably assume that most types of real estate would decline as well. So, yes, and then the other part of that question was the U.S. Production and exports of grain. You have in post-bubble periods the weak pricing power prompts tremendous improvements in productivity. So this is when you were having, reapers and thrashers and whatnot. All of these are tremendous advances in productivity, and the U.S. became, and as well as Canada, became very effective. Railroads, shipping improved, so it just broke in. But the main thing was, Willem, it was another typical post-bubble contraction, and following the bubble of 1873, and it was in England quite a nasty contraction, so that British economists in 1884 came out and said, that we'll call this the Great Depression. And the irony is that British economists, senior ones, were still analyzing it as the Great Depression as late as 1939. And by that I mean the 1873 to 1895 contraction. And then in the 1939-40, said, we have another Great Depression, we'll follow that one. So the answer is the decline in farmland values was, I would think, typical of a post-bubble contraction.
Thank you so much, Bob.
Very good, and we'll talk to you next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. If you have any questions for Bob, you can email us to info@howstreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.